If you're self-employed, you actually have more options to verify your income than you would if you were just an employee. Let me show you exactly what I mean. So you've obviously got the traditional method to verify your income if you were self-employed. That is tax returns. So if you operate as a company, you'd be giving in your company tax returns, individual tax returns, financial statements, notice of assessments, etc. Most banks will want either the most recent years or an average of the most recent 2 years. However, what happens if you don't actually have tax returns? Maybe you haven't been around long enough, or perhaps the tax returns that you've lodged in the past aren't really reflective of your current business performance. Well, you have other options. One great option is a director wages policy. So if you were a director of a company and you were paying yourself a consistent wage from that company, then you can use that wage in isolation as part of servicing and completely ignore what's going on in the company. So all you need is a minimum of 6 months of evidence of this, and they usually want payslips and an ATO income statement or a accountant's letter to actually confirm that you can pay yourself that salary and it is ongoing. Now, another option is a low doc or alt doc loan product. Now, with these loan products, they actually verify your income using either an accountant's letter, BAS, or business banking statements. Now, a caveat to using this type of loan product is the fact that the major banks don't actually offer these loan products. You're going to have to go to a non-bank lender, and with that will come higher interest rates and sometimes higher fees as well. In saying that, you have to understand this is solution-based lending, and the plan always is to refinance you back to a major lender once you are eligible to verify your income using tax returns or using director salary. If you compare this to just being a pay-as-you-go employee, unfortunately, all they're going to go off is just what's on your pay slips. I understand there is some variance in terms of non-base income like overtime, commissions, bonuses, etc. However, for the most part, there is not much variance between lenders. When you are self-employed, you have the luxury and flexibility to pick and choose which type of income verification method is going to yield the highest borrowing capacity result. As an example, I recently helped a self-employed electrician. We used his most recent year's tax returns in isolation, which yielded a borrowing capacity of around $850,000. Now, since those tax returns were lodged over 12 months ago, business has picked up significantly. So we got the most recent 2 business activity statements, we annualized that figure, and that yielded a borrowing capacity result of $1.4 million. Now, we did have to go to a non-bank lender whose interest rate was 0.5% higher than the major banks. However, that did allow him to actually buy the property, and then once he lodges his tax returns for the upcoming financial year, we'll refinance him back to a major lender.